Welcome to this deep dive. Today, we are tearing into the Scotiabank BNS Q4 2025 financial results call. It hit the wires pre-market on December 2nd and really sent the stock flying.
It did. And our mission today is to figure out if that big positive market reaction was actually justified. We're not just reading numbers here. We're trying to see if the execution and the forward guidance really support this new bullish story.
And we're looking only at the adjusted constant currency figures.
Yeah, exactly. That's what management is pointing to. They're saying these are the metrics that define the real strength of the core business.
Okay, so the stock just popped right away. What were the numbers? What were the, the concrete figures that made the market go, okay, this is real?
Well, it really starts with the absolute beat on earnings. The adjusted EPS for Q4 came in at C$1.93.
Which was way above consensus.
Way above. The consensus was C$1.84, so that's a solid 5.5% beat. And crucially, the top line, the revenue, backed it up. Q4 revenue was $9.8 billion, which, again, was comfortably ahead of what everyone was expecting.
Like the full year.
For you, the key signpost here is the full year 2025 adjusted diluted EPS. It grew 10% year over year. That's management basically delivering on the trajectory they promised.
Right. So that 10% EPS growth is the signal, but the market also rewards efficiency. I mean, did they show they are successfully controlling costs after all this restructuring?
They did, absolutely. The underlying profitability metrics, they really show that improvement. The return on equity for Q4 hit 12.5%. That's up 190 basis points year over year.
Which is a big move.
It's a huge move. But pay attention to the adjusted efficiency ratio. It improved by 180 basis points, landing at 54.3%.
So for every dollar they make, they're spending about 54 cents.
Exactly. And that's the proof. That shows the restructuring is translating directly into positive operating leverage right now.
And to just round out the snapshot, what's their capital position looking like? That's their ammunition for the future, right?
Rock solid. They finished the year with a CET1 ratio, that's their main capital buffer, of 13.2%. I mean, it's well above the minimums. It means they have a huge war chest, significant capacity for growth, or frankly, for any unexpected challenges.
Now, we know the reported numbers were weighed down by that massive $373 million restructuring charge.
Right.
And that cost was, excluded from these adjusted results we were talking about. But that's still a huge amount of money. Was that worth it? Or is it a drag?
It seems like it was necessary. That charge was really aimed at simplifying their Canadian operations, which are massive, and also right-sizing the global banking and markets division, especially in Asia, where they're pulling back.
And you see the payoff.
You see it right in the segment results.
Yeah.
The strength was really, really concentrated in those fee-driven businesses.
Okay, let's talk about that. Let's focus on global banking and markets, or GBM. The numbers there looked like a moonshot.
They really did. Net income up approximately 50% year over year. And that wasn't just, market luck. It was driven by constructive capital market, sure, but also incredible growth in their underwriting and advisory fees.
I saw a note on that.
Fiscal 2025 was the best year in their history for those fees, up 35%. But what's really fascinating here is the proof that their whole North American corridor strategy is working. The U.S. contributed a full 50% of GBM's total earnings for the year.
50%. Wow.
And this shift is validated by the successful launch of their expanded U.S. cash management business. It's all connecting.
So GBM is firing on all cylinders. What about global wealth management? Did it keep up with that high-quality fee income?
It certainly did. Wealth management earnings grew in the high teens year over year. Part of that was rising markets, which helped them get robust AUM growth of 16%.
But what was the bank's own execution part in that?
I think the key differentiator here was internal. Management cited huge success in cross-segment referrals. We're talking $15 billion, an 18% increase. They're getting much, much better at capturing that money in motion across the whole bank.
Okay, let's turn to the big one, Canadian banking. Net income was only up 1% year over year. $941 million. I mean, to be frank, that sounds pretty flat for their domestic flagship.
It does, and that's the critical challenge they face, no doubt. They are heavily focused on driving improvement by increasing what they call primacy. It's bank jargon for client stickiness.
So how are they trying to get stickier?
Well, they noted success in growing core low-cost retail deposits. So your day-to-day and savings deposits, those were up 6 to 7%. And they're getting that stickiness through their Mortgage Plus's bundling program.
The Mortgage Pluses program. So what does that mean for the average person?
It just means they don't sell you a mortgage in a vacuum. They bundle it with a checking account or credit card, maybe some investment advice. And they announced that over 90% of their new mortgages now include a bundle.
So they lock the client in for life.
That's the idea. It boosts long-term profitability and really cuts down on churn, which is vital when your headline net income growth is only 1%.
All this restructuring, this new profitability,
Right.
it points to one thing, right? Management is finally done cleaning up. They're done with the exits from Colombia, Costa Rica, Panama. Capital is now coming back to that North American trade corridor.
It is.
So what's the tech focus for them going forward? Where are they spending the money?
Looking ahead to 2026, it's really two things. The expansion of their global transaction banking, or GTB, platform, and then dedicated AI investments. It's all about building better, faster plumbing for that high-quality recurring fee income. It's just much lower risk than lending.
And this strategic shift, this confidence, it all leads to the blockbuster 2026 outlook they sold the market on. What was the promise?
The promise is substantial. It's aggressive. Management is now targeting double-digit EPS growth in fiscal 2026.
Double digit.
Double-digit. And they expect the return on equity to move toward 14% plus. And they even hinted they might hit that target a year earlier than they first thought.
Okay, that double-digit EPS growth seems aggressive, especially if, like we just said, Canadian banking is only growing at 1% right now. How does the math on that even work?
It really relies on two big factors. For Canadian banking specifically, that double-digit EPS growth is expected to come from mid-single-digit pre-tax, pre-provision growth. That's core profit, combined with a really crucial factor, PCL normalization.
PCL normalization, provision for credit losses.
Yeah.
So that sounds like they're just betting on the economy getting better next year. What's the actual guidance on credit costs?
And that's it. That's the crux of the tension. The PCL ratio for Q4 was 58 basis points. For fiscal 2026, they've guided the impaired PCL ratio to be in the high 40s to mid 50s basis points range.
So lower.
Lower. They expect that normalization to kick in probably after a little bit of a bump in the first half of the year as higher rates fully filter through.
But we have to acknowledge they are still seeing stress pockets today, right? Where's the risk?
Correct. You can't ignore it. The 90-day plus mortgage delinquency ticked up 4 basis points just this quarter. And that was driven mostly by weakness in the Greater Toronto area and on unsecured lines of credit.
And what's management's defense there?
Well, they were keen to stress that 94% of their Canadian retail exposure is still secured. And the average FICO score on their book is very high. It's over 790. So they're managing the stress, but no, they're not immune.
Okay, let's shift to another area of scrutiny. The hot topic from the Q&A was private credit. The whole market is nervous about this. What did the bank have to say about its exposure there?
They gave some good transparency. They said they have about, $31 billion in loans out to non-bank financials. And they broke that down, saying roughly half of that is what they'd categorize as private credit, which itself includes things like subscription finance and CLOs.
And what's their argument for holding so much of something that's generating so much worry?
Disciplined underwriting, that's the line. They stressed they're highly selective, they're mostly participating in A or A plus rated tranches, and they run rigorous stress tests. Their internal models show that even in a severe downturn, projected losses would be a fraction of the net revenue that this high-margin business brings in.
So they feel the reward is worth the risk.
A well-managed risk in their view, yes. So what does this all mean for you? The market has already reacted, right? The stock hit an all-time high on the TSX. The sentiment has clearly shifted. The market is willing to look past some of these immediate credit issues.
And buy into the new story.
And actively buy into the management's refreshed, execution-focused narrative. Because the segment results, I think, prove the pivot is real.
This is where it gets really interesting then. What is the key tension that you should be watching closely as we head into 2026? What could possibly derail that double-digit target?
The tension lies entirely in how reliable that PCL normalization is. The whole bullish guidance for FY26 relies on two things. First, the bank successfully driving fee growth and GTB expansion, which they can control.
Right.
And second, crucially, external macro factors allowing credit costs to actually moderate. If you see persistent headwinds, elevated Canadian unemployment, maybe trade uncertainty with the U.S., if that stuff lingers longer than they predict, consumer stress is going to cap the upside. You have to watch credit costs versus fee revenue growth very closely.
Okay, we've distilled the narrative, the results, and the risk. Now let's transition to our final segment, where we look at the extreme edges of possibility.
This is the part where we always remind you, this is not financial advice. We simply pitch one outrageous but plausible trade idea that we derive for the nuances of the earnings call. It's a counter-consensus bet.
Okay, lay it on us. Given that strong capital position, what's the trade?
The outrageous but plausible trade idea here is to buy long-dated call options on Scotiabank, on BNS, betting on a near-term strategic M&A move. Specifically, a small tuck-in acquisition in the U.S. wealth space.
Wait a minute. Didn't management explicitly state M&A was third on their capital priority list? Right behind organic growth and share buybacks? Why bet on something they basically downplayed?
Because that CET1 ratio at 13.2% is a loaded gun, and they are highly motivated to accelerate that ROE beyond their 14% target. Management admitted during the Q&A that they need to fill specific capability gaps via tuck-ins in the U.S.
And they were specific about what they needed.
Very specific. They mentioned the need for U.S. offshore booking points for wealth clients. A small, high ROE U.S. wealth acquisition, despite the official line, would be a powerful near-term catalyst. It would surprise the market, it would accelerate the North American corridor strategy, and it would instantly validate their shift to higher quality fee revenue. They have the capital, and they have the need.
Super crisp. So, to summarize, the Q4 results were really that critical proof point that Scotiabank's big strategic reset pivoting away from lower return international markets and into these higher quality segments is actually paying off. This sets the stage for a critical 2026 where management has to deliver on those very ambitious targets.
And here's the provocative thought we'll leave you with. Management spoke really confidently about Canada's renewed focus on natural resource development and infrastructure. Given the bank's refocused capabilities and that massive 50% year-over-year earnings surge in GBM, how quickly will the bank's advisory role in major Canadian energy and infrastructure projects translate into visible revenue synergies in their fee income? That strategic win will be the next key check for this whole thesis, far beyond just managing the credit cycle.